Think about the place you're in right now: the apartment, the office, the shop downstairs, even the warehouse that helped get something delivered to you. Most people don't think of buildings as a business you can buy into. But D.P.C Holdings is asking public investors to look at property that way. D.P.C Holdings, trading under the ticker D.P.C, is a UK-based real estate company that buys, sells, and leases properties. This isn't an app you tap or a gadget you hold. It's closer to the quiet rent and property world behind everyday spaces. So the cursor stocks question is simple. Is this a real estate engine worth understanding, or just a big price tag? Here's the easy way into the business. If a company owns or controls buildings, it can make money when tenants pay rent, when property values rise, or when it sells an asset for more than it paid. That sounds familiar. The hard part is that buildings also need cash, patience, and good timing. The company description is plain. It buys, sells, and leases real estate properties. That can be a steady business when tenants pay and values hold up. But it can also be unforgiving when financing gets expensive, buildings sit empty, or a sale happens at the wrong time. This IPO is the moment a private company starts selling tiny ownership pieces of itself on the stock market. D.P.C is set to list on the NYSE on June 25, 2026. The ticker is D.P.C, and the offering is still pending, so investors are looking at expected terms, not a completed trade. The planned price range is between $28 and $32 per share. Since the company plans to raise about $746.7 million by selling 23.3 million shares, the math points to an expected price around $32 a share. That's the high end of the range, but still not final until pricing is done. That headline raise is big. About $746.7 million is not pocket change for a property company. It's enough money to change what the company can buy, refinance, or build next. For a beginner, the key is not just the size of the raise, but what that money is supposed to do. Companies go public for a few normal reasons. They can raise fresh money, give early backers a path to sell later, and become more visible to lenders, partners, and customers. In real estate, visibility can matter because confidence affects financing, and financing affects almost everything. Now compare the IPO raise with the business itself. D.P.C reported about $855.6 million of full-year revenue, which is the money coming in before expenses. The planned raise is almost as large as one full year of revenue, so this offering is not a small side event. It could materially reshape the balance sheet. But revenue is only half the sentence. Revenue tells you money flowed in. Profit tells you whether the business kept any after the bills were paid. D.P.C brought in about $855.6 million, but still lost about $176.8 million. That is the first real tension in this story. A loss doesn't automatically make an IPO bad. Property companies can spend heavily before assets mature, and public money can give them room to reposition. But it does change the question. Investors are not just buying buildings. They're buying management's ability to turn those buildings into better economics over time. The bull case starts with something ordinary. People and businesses still need physical space. Apartments, offices, retail, storage, and logistics properties don't disappear because markets get nervous. If D.P.C can own or lease the right assets in the right places, each property can become a source of repeated cash flow. That brings us back to the room you're in. A tiny slice of rent, lease payments, and property value is what eventually becomes revenue for businesses like this. The dream is boring in a good way. Collect income, manage assets well, and use scale to make smarter deals. But here's where the story gets more interesting. Real estate is never just about buildings. It's also about debt, interest rates, and timing. If borrowing costs rise or buyers get cautious, a property that looked attractive yesterday can become harder to finance or harder to sell tomorrow. The central question comes back again. Is the price tag describing what D.P.C is today, or what investors hope it becomes? A final valuation hasn't been set yet, because the offering is still pending. That matters. Without that number, you can't cleanly say how expensive the whole company is versus its revenue. Competition is also easy to understand here. D.P.C is not competing with one obvious app or one famous brand. It competes with other property owners, developers, landlords, funds, and private buyers who all want the same attractive assets and tenants. When everyone wants the same building, returns can get squeezed. This is why the loss matters so much. A company can survive losses if it has a clear path to better cash flow. But if losses stay high while property deals get tougher, public investors may start asking whether the IPO money is buying growth or just buying time. Another detail to watch is who gets the IPO money. When shares are newly issued, the company gets cash to use in the business. When insiders sell, more of the money goes to existing holders. The available terms show 23.3 million shares being offered, but investors should still check the final prospectus for the full breakdown. After it lists, the watch list is simple. First, does revenue keep moving in the right direction? Second, does the loss shrink? Third, does management show that the IPO cash is helping the property business, not just covering old pressure? Those signals matter more than a first-day stock pop. So here's the balanced version. The dream is a real estate company using public market money to become stronger, larger, and more stable. The doubt is that it is still losing money, the final valuation isn't set, and real estate can turn quickly when financing gets tight. And that's the useful part of this IPO story. You don't need to know every Wall Street term to follow it. Ask what the company sells, who pays, whether it keeps any profit, and what price investors are putting on that future. Follow the cursor stocks for IPO stories before they trade. This video is for information and education only, not financial advice.